Hi, this is a video that I'm just going to go over an introduction to how to start the regency petroleum problem. So this case study is described in the PDF that I gave you online, and it describes all the things you need to know about this decision that's coming up. So what the decision is that they need to know whether they should build a new facility or liquidate everything that's in the old facility, because they can't use the old facility anymore. So if you liquidate it, you sell all the oil that's in it, and but if you build a new factory, then you continue to get the benefits of that. So this has a bunches of data in it that you need to know how to work on. The main things that are going to be important in doing this calculation is to understand how to calculate the cash flow that you want to have for this project. Now, there's a couple videos on Canvas that'll show you how to calculate cash flow and depreciation so that you can see what's going on in these two concepts, because those are the two concepts that we didn't cover completely in class. So I'm just going to go through this. So this is organized a little bit different than the Where to Live project. This one has years across the top and items or the income statement down the side. So on the Where to Live, this present worth factor, the present worth factor here was a column, and instead it's a row here. And you know what? This is the wrong wrong number of decimals for this. So because we're using 20 years, I want to make sure that gets a better decimal points on that. So we're usually used to 4 decimal points, so I just changed that. So let's go ahead and look at how to do this calculation. So what we do here is we have the profit from the sale of the heating oil here, and I'll show you in a minute how to calculate that. And then from that we have expenses that are ongoing expenses, and then depreciation. So these two items are subtracted from that item to get to the taxable income, and then taxes is 28% of that number. And so the cash flow is going to be equal to the income minus the cash expenses minus the taxes. And that's what the cash flow is going to be. And then there's also an increase in working capital that you need to include, and then also capital expenditures that are occurring every along the way. So this value, net cash flow, is this number minus those two numbers, and that is the net cash flow. These are the arrows, so I have those arrows running all the way across here. You can see this initial times 0 expense, and then all of the positive numbers along. And then I multiply that by the present worth factor and add that up, and I get a value that is 822 million. That's the present value of building a new factory. Now, there's also behind this, what I've done is I've created a couple spreadsheets here that help to get to calculate these numbers. So I'm going to go ahead and look at the expense ones first. So the capital expenditures they say in the case study, they say it's going to cost 25 million, plus you need to have new equipment. Along the way, you have cars every year, trucks every year, you have a computer upgrade, you have this item, 1.5 million, which is a pump replacement. So they tell you all of these values and when they occur. So I went ahead and included that, and so I have this bottom line, which is the capital expenditures necessary. The other thing is they tell us there's rent, and then there's operating expense, which adds up to the total tax deductible expenses. Then when we look at working capital, it's actually one of the most important things we need to calculate here is the profit per year, because they said that they're going to sell 15 million barrels and it'll be $80 a barrel, and then that'll increase at 2% along the way, and then the 15 million barrel production will increase 10%. So I just took that value, multiply that, and it says the profit is 10% of the revenue. So this is revenue, 15 million barrels times $81.60 a barrel, and then this is 10% of the multiply. You can see here, I don't know if you can see that, I have a 0.1 is the profit. So that number is the number that comes over here in the profit line. And then what happens is they have a change in working capital, and they said working capital is 10% of revenue. So I took this number and I multiplied by 10. And then that, as revenue increases, that number is going to increase. So this is the working capital increase, which is sort of like a capital expenditure, and I need to include it as an increase in working capital. So that number then goes here, increase in working capital. That number goes there, and that's where I got that. So that's a little bit about that. The other thing we need to do is think about depreciation. So what depreciation is on these capital expenditures that we have here on the top here. Each of these are purchased, but they last for a long time, and it tells you how to sort of spread that expense over time. So this 25 million, they said it's a Macker's 10-year depreciation. So what that means is I'm going to take this this Macker's 10-year depreciation here number, and I'm going to multiply that by the 25 million. So I take the 25 million times that number, which is the first year depreciation, and then I take the 25 million times that number, which is the second year of depreciation, then times that number. So what that is that's spreading the cost, all of those costs, across the 10 years after you make the expense. And that's what depreciation is. And again, you might want to watch the video when I explain what depreciation is. And so all of these items that are on this page here need to be depreciated. So I have the new equipment needs to be depreciation, the computer upgrade, the pump replacement, and then every year we buy trucks. So the first year we buy the truck, it's 100,000, and I need to spread it over these 6 years. And so then I do that one. And then in year 2, I buy some trucks, but it starts in the second year. In year 3, I buy trucks, but the depreciation starts in the third year. So what I'm going to do then is this is going to be the summation of all those depreciations from all of those items that have been depreciated. And then that number goes here, right here. That's the depreciation value. So now we can just do the calculation. I guess the other thing to just notice is if you liquidate, what's going to happen is you're going to sell all of the oil that you have. So the working capital that you can sell is 120,000. So we go to these expense items here, working capital, that's 120 million, and that value then is going to be what you can sell. In addition, you're going to sell the old equipment, and you have some tax applications for it. I hope that's a quick little introduction to how to do the Regency Petroleum.